Welcome again to Studio 14's Overton County Magazine. I'm your host, Jerry Stovall. Overton County Magazine is a show designed to bring our viewers a look at some of the interesting as well as informative people and events occurring in and around Overton County. Some of our stories are videotaped on location, while still others will be brought to you straight from Studio 14. So why don't we all sit back, relax, and thumb through this week's magazine. In this segment tonight, our guest is Larry Eldridge, a local CPA, and we've asked him here to give us a few tips on the new tax laws. I think everybody knows that there's a lot of sweeping changes that came through on this last revision. So we'll just say, how you doing tonight, Larry?
Hi, Jerry. Thank you for inviting me. It's an honor to be here on Channel 14, considering the tremendous job that you're doing with both quality and quantity of local programming.
Well, we appreciate hearing about that.
Channel 14 has become the most watched channel at our house.
Well, I'm glad to hear that too. You know, to get on into this tonight, because you've got a world of things to tell us, I know. This 1986 Tax Reform Act, all of us have heard it. You know, we've heard it on TV, and that it's affected this and that. And of course, there's a lot of things that don't affect the everyday person, or like me, a businessman. There are certain things that affect me more so than other people. But can you kind of generalize and give us an idea of what it actually did?
Yes, the 86 Reform Act is the most sweeping tax change we've seen since World War II. There was a great deal of publicity about it. When Congress began work on it about 3 years ago, the phrase that we heard most often was simplicity. Whatever the new tax law is, it is not simple. Another goal that was set later on as Congress was working on it was that it be revenue neutral. What that means in simple terms is Congress wanted to change the law to eliminate some tax loopholes and tax shelters, to lower tax rates, and at the same time attempt to collect overall about the same amount of tax money as they were with the old law. So we think we have revenue neutrality, but we don't have simplicity. Tonight on our program we'll be talking in very vague generalities because the tax law is very technical, and anytime we apply tax law we have to look at facts and the law and the combination of the two. Anytime you change the facts, the outcome of the tax law may change. So as I say, we'll be talking in very broad generalities here. But one of the things that the new tax law did was to greatly reduce the number of tax rates that we have in the Internal Revenue Code. In the past we've had 14 different tax brackets, ranging from a low of 11% up to a high of 50%. Now, once the new tax law was completely phased in 1988, most taxpayers will only have two tax brackets. They'll pay tax on part of their income at 15% and on another part of it at 28%.
Okay, you'll be paying two different taxes within the same income. Is that right? Is that what I get out of that?
Oh, well, that's where we need to talk about marginal tax rates. With the income tax law, we don't pay the same amount on each dollar that we make. When you hear someone say they're in the 30% tax bracket, that doesn't mean that they're paying 30 cents of every dollar of income they have. It means that they have paid tax on part of their income at 11%, another part of it at 12%, another part of it at 14%, and so on.
I didn't realize that.
What they're actually doing when they say they're in the 30% bracket is they are paying 30 cents on the dollar of every additional dollar.
Okay. Oh, okay.
but not
yeah.
on every dollar
Yeah.
earned.
Okay. That's right. You have a base rate that you pay on the first fixed amount, and then above that you pay a percentage on an excess, isn't it?
Right.
Mm-hmm.
The first thing that takes place in calculating the tax is to take into account the personal exemptions that you have for yourself and your family. In 1986, each family member was entitled to $1,080 for their personal exemption. By the time the new law is completely phased in 1989, that personal exemption will be $2,000 per person.
Now that sounds good.
That's,
Except I'm running out of kids.
that makes a difference. The standard deduction will also increase, which is another allowance that you have in the tax law, and that's the allowance that people who do not itemize deductions get anyway. On a joint return for a married couple in 1988, that amount will be $5,000. So once the new law is fully in place, we'll see that a family with 3 people can have income of $11,000 without paying any income tax. They'll have 3
what is
personal
it now?
exemptions at $2,000, and then they'll have the $5,000
Okay, that's
additional standard deduction.
where they stand now in comparison.
Now they would stand between 6,000 and 7,000.
Okay, so
Without
it's almost
tax.
double that.
That's one place that we do have some simplicity in the new tax law. It will remove a great many lower income families from the tax rolls. Those people will owe no tax, and obviously that makes their tax return simpler.
Okay, who's going to pick up the slack in this then? If you know they're not going to pay the tax, then of course it's going to be moved on to somebody else. Be the higher income brackets be paying this?
Some of the things in the new tax law that increase taxes will be the elimination of the preferential tax treatment for long-term capital gains. There'll be the repeal of the investment tax credit.
I hate to hear that.
There is the changing in a great many types of deductions, and there's a real attack on tax shelters, which we've heard so much about.
Of course, I can understand that.
So,
Well, how do you feel that's going to affect, just to kind of stop you in the middle of that, because this is something that affects me, of course. How do you think it's going to affect the growth of industry by taking off the investment tax credit part of it?
I don't think anyone knows yet. The investment credit has been in the tax law and out of the tax law several times since 1965.
Oh, it has.
Congress has used that as a means of attempting to stimulate the economy during slow times. So that's the reason that it was in the tax law.
Oh, okay.
And it has been taken out and put back in, and now it's taken out again.
Okay.
But, the thing that makes it so difficult to attempt to project what will happen to the economy, I think, has more to do with the change in the long-term capital gain treatment than in the investment credit. Because people who have invested in stocks or land or other investments in the past have had a very significant tax break on the income from those. For example, if they had invested that money in a savings account and had realized interest income from it, they would have paid tax on every dollar of interest income. But by investing in stocks or in land, holding it for several years and then reselling it, they realize what the tax law calls a long-term capital gain. Under the old law with the long-term capital gain treatment, those gains that were realized from the sale of land or stocks were taxed only 40 cents on the dollar, and you were able to exclude 60 cents on the dollar.
Oh,
which
well, that was desirable then.
Yes, it was.
Yeah.
It meant that if you could realize a long-term gain of $10,000, you only paid tax on $4,000.
Yeah, I can see. That'd be better than putting it in the bank then.
But under the new law, we'd pay tax on every dollar, although we're told that the lower tax rate should compensate for that.
Okay, so that's a big difference then.
Yes.
All right. Now, as far as itemized deductions, of course, everybody has itemized deductions. I'll say, if they've got enough itemized deductions to go along for them. What kind of effects is there going to be in that?
Itemized deductions, as you say, are what most people refer to as the long form when they're preparing their tax return. That simply means that they have listed separate deductions for things such as medical expenses, taxes, interest, contributions, and so forth. And that their total on those things amounted to more than was available to them as a standard allowance. Some itemized deductions are being cut back under the new law. The deduction for medical expenses will now be less than it was in the past. We'll no longer be allowed to deduct sales tax on our tax return for taxes paid on automobiles or new house materials. Property taxes will still be deductible as itemized deductions, and state and local income taxes will still be deductible. There's some changes being made in the area of what kinds of interest you can deduct. You can still deduct the mortgage interest on your home for a first and second home. By carefully qualifying a home equity loan, you can deduct interest for that, but you won't be allowed, after the new law is completely phased in, to deduct consumer type interest for credit cards, charge accounts, car loans, and so forth.
Oh, you still can right now, though.
There's a gradual phase out. In 1987, 35% of that consumer interest will not be deductible, and 65% will be.
Okay.
Contributions have always been an itemized deduction until the last 2 years, and they will continue to be itemized deductions. In 1986, however, you were allowed to deduct all your contributions whether or not you itemized. One other change that's being made in the itemized deductions area has to do with employee business expenses, which are unreimbursed by the employer. For example, an employee that travels, uses his automobile in his work, or an outside salesman that pays all his own expenses and is not reimbursed from his company. In the past, those things have been deductible regardless of whether or not the person itemized. The new law changes those to itemized deductions.
Okay, it just makes a little more work for them.
Makes a little more work for them.
You can take them, though.
Except that, so you've lost something there, and also the new law says that qualified deductions for meals that you can substantiate under the tough travel and entertainment rules will be only 80% deductible. So a meal that costs $20 will have only a $16 tax deduction.
Okay. That'll affect a lot of people, I'll say.
Right. Another thing that a lot of people have been interested in is the change in the individual retirement accounts. And we heard a lot about that on the news when the bill was being written. And what we finally have now is a situation where this year couples who earn under $40,000 can still continue to fund and deduct their individual retirement accounts.
Okay, now can they still take the same amount as they did before?
Yes, they can, and that's a deduction that they can take without itemizing. What's changed is that couples who have either the husband or wife working for an employer where they're covered by a pension plan at work and whose income is more than $40,000 will see their IRA deduction phased out. And by the time their income reaches $50,000, they have no more deduction for an IRA.
Oh, okay.
Have some changes too that are affecting tax returns for children. A great many people didn't realize this, but one of the most universal tax shelters that we've had have been in connection with claiming their children as dependents on their tax returns. If you had a youngster who was old enough to work and have some income of their own, they file under the old law their own tax return, claim themselves as an exemption on that return, and then when the parent filed his return, he also claimed an exemption for them. So those children counted twice. And that was legitimate, and it was a good tax shelter for a lot of families. And sometimes they didn't even realize they had one. As a matter of fact, tax shelters are usually defined as deductions that you get to take that I don't.
Oh yeah, not same for everybody.
Right.
Okay.
Under the new law now, if the parent is entitled to claim that you're dependent on the parent's return, then the child can't claim himself as an exemption on his own return.
Okay, that, in a way that's kind of bad because a lot of kids will have a job when they're in school, and I think before they just never been enough to pay any income tax. They got it all back at the end of the year, at least mine did, I believe. And so what you're saying now is if they have a job and they pay in income tax, they just don't get it back.
Not necessarily. Okay. They'll still be entitled to a standard deduction that can be applied against the income that they earn from working. But if they have unearned income, and such as interest or dividends or passive type income.
Okay, just working income, more or less.
That unearned income can only be offset by $500 of their standard deduction. So if you have a child who has interest income of between $500 and $1,000, the first $500 won't be taxed. The next $500 will be taxed at the child's tax rate, which under the new tax rates will be 15%. And then if the child has the unearned income in excess of $1,000, it's going to be taxed at the parent's top tax bracket. So where in the past we've seen parents shifting savings and investments into the children's name in order to move it to a lower tax bracket, that will be discouraged now.
Okay, that is actually closing a loophole. That's what it's doing. It's a way to close it off.
Yes.
I can understand that. Okay, now I believe we were talking earlier, and you said something about the deduction you get for the couple, both husband and wife working, is going to be eliminated at future time.
That's correct. Under the old law and on your 1986 tax returns, where a husband and wife filed a joint tax return, and where both of them worked, the net earned income of the smaller earning person had a 10% deduction,
Right.
which was called the married couple deduction. It actually came about a few years ago as a result of what some people referred to as the marriage penalty tax. Some people had learned that it was less expensive under the law 5 or 6 years ago to file as two single people rather than as a married couple. And there were some couples who on December 31st divorced, and then in early January remarried.
All of them?
And
Did they all remarry in
we
January?
we can't promise that. But at any rate, the married couple deduction was put in there to try to offset that disadvantage, and now that's being taken away.
Okay.
Again, under the guise that the new tax rates will be low enough to offset it.
Okay. So how do you feel all in all for the new tax rates? Is it a fairer way to go, or do you think it's rougher? I'll tell you one, I got to say this, because in our business, we've ran across this, but who in the world devised the W-4 form? That has got to be the most, it's almost as complicated as a 1040.
I'll tell you a story about the W-4 form. That is the form that every employee fills out to tell his employer what marital status he wants to claim and how many withholding exemptions he wants to claim for income tax withholding.
It's been a law, I think, it has to be redone this year.
That's right. In the past, you always were required to fill one of those out when you went to work for a new company, and then you never had to fill out another one unless you wanted to change what was on it. The new tax law says that every employee must fill out a new Form W-4 by October 1st of this year. And the IRS, amidst a great deal of publicity, last year brought out a 4-page form that confused everyone. And the story about it is this: when the Secretary of the U.S. Treasury, who was actually the boss of the Internal Revenue Service, sat down to fill his out, he said, "This thing's too complicated, redo it." And as a result, last week in the mail I received some shortened 2-page W-4 forms.
Yeah, I believe we got some in the mail too.
But what we're seeing, and during our tax season this year, as we prepared tax returns for our clients, we used a computer program that we've purchased to project their 1986 income and deductions forward for 4 years to see what effect the new law would have on them. And again, we're generalizing, but for a great many people, there won't be a lot of difference overall in the final bottom line tax that they pay. The thing that's really going to be different now is that tax preparers will have a great deal more work, because almost every line on the tax return will be different, even if the bottom line comes out about the same.
I'm glad you make mine out. I wouldn't want to look forward to this year's if it's any more complicated than it's been in the past. Now that's something that I think we probably ought to stress here. Anybody that has a problem or potential problem probably should seek some advice from an expert, which I put you in that category. That's your business. You do it day in, day out, and you school yourself on any changes, and I'd say you just stay abreast of it all year.
Well, we spend a great deal of time and money in continuing education and purchasing textbooks and computer programs and so forth. But there are some times when it's wise to consult a CPA. One of those is when you're starting a new business or buying a new business or selling a business. There are some planning opportunities there. And tax planning can be done before a transaction takes place. It's too late after the contract is signed.
So everything's changing.
And there's one other area when you should be really very careful because of a change that was made 2 years ago, and it's not very well known. But if you happen to be involved in a business or a farm and you're about to make a sale of some of the equipment or assets that you've been taking depreciation on, and if you're about to make a sale on the installment basis, where you'll collect a down payment and payments over a number of years, you really should seek some advice before you sign that contract.
Larry, it's been real informative tonight. It sounds like there's a lot of good things coming in the new tax law, possibly, but I hate to say it, but we're losing some good ones too. Hopefully it'll balance out on the plus side for me, and I definitely want to thank you for being with us tonight. Hope maybe at a later time we can get you back up and get into more detail. There's so much in the tax law, it's hard to cover it in one show, I know. But we have enjoyed having you here.
Thank you. It's been my pleasure.
And hopefully that's enlightened people to some of the new tax laws. And of course, like we said earlier, if you need some help, professional help, seek it out and get it done right. I would like to thank everyone for watching tonight. We hope that you have enjoyed our magazine, and be sure and tune us in next time. We would also like to invite you to send us your comments and ideas for future shows. This is Jerry Stovall saying thank you and good night.